Hey everyone, welcome back. In this video, we're going to talk about one powerful but simple skill in trading and investing: how to spot possible reversals in a stock's trend using candlestick patterns. Before we start, quick reminder: nothing here is financial advice. It's for education only. Always do your own research and never risk money you can't afford to lose. If you want more easy-to-understand videos about the stock market and investing, hit the like button, subscribe, and turn on the notification bell so you don't miss future videos. Also, drop a comment at the end telling me which candlestick pattern you're going to watch for this week. Alright, let's dive in. When you open a stock chart, you usually see a lot of red and green candles, but what do they actually show? Each candlestick shows you four things for a specific period of time: the opening price, the closing price, the highest price, the lowest price. The thick part of the candle is called the body. The thin lines above and below are called wicks, tails, or shadows. If the candle is green, the price closed higher than it opened. If it's red, the price closed lower than it opened. The key idea: the shape of the candle, especially the length of the tails, tells you a story about what buyers and sellers were doing during that time. A trend is simply the general direction of the price. In an uptrend, prices keep making higher highs and higher lows. In a downtrend, prices keep making lower highs and lower lows. In a sideways trend, price is moving in a range and not going strongly up or down. A reversal is when that main direction changes. An uptrend turns into a downtrend. A downtrend turns into an uptrend. We can't see the future, but candlestick patterns help us guess when a trend might be getting tired and ready to turn. Now let's talk about those long tails, because this is the key idea for this video. A long tail, or wick, means that during that time period, price moved far in one direction, but then got pushed back before the candle closed. A long lower tail means sellers pushed the price down, but buyers came in and pushed it back up. A long upper tail means buyers pushed the price up, but sellers stepped in and pushed it back down. Long tails often appear near the end of a trend and can signal that the current direction is weakening. They don't guarantee a reversal, but they're a big clue that the battle between buyers and sellers is changing. Let's start with bullish reversals, when a downtrend might be getting ready to turn up. Imagine a stock has been falling for several days or weeks. Then you see a candlestick with a small body near the top of the candle, a long lower tail. It appears after a series of red candles in a downtrend. This often means something important. Sellers tried to push the price down, maybe to new lows, but buyers refused to let it stay there. Buyers came in, scooped up shares, and pushed the price back up before the close. This type of candle is often called a hammer. It looks like a little hammer with the handle pointing down. A hammer at the bottom of a downtrend is a sign that the downtrend might be losing strength and a reversal to the upside could be coming. But remember, one candle alone is just a clue, not proof. Many traders wait for confirmation, like the next candle closing above the high of the hammer, or higher volume, showing real interest from buyers. Section 5. Bearish reversal candles, long tails at the top. Now let's flip it. Imagine a stock is in a strong uptrend. Price has been rising and people are excited. Then you see a candlestick with a small body near the bottom of the candle, a long upper tail. It appears after a series of green candles in an uptrend. This suggests buyers pushed the price up, maybe to a new high, but then sellers came in and said, "That's too expensive." They sold heavily, pushed the price down, and the candle closed much lower than the high. This candle is often called a shooting star. It looks like a star with a long tail pointing up. At the top of an uptrend, a shooting star can be a warning sign that the uptrend is weakening and a downward reversal could be on the way. Again, confirmation is important. Many traders look for the next candle closing below the low of the shooting star, or a drop in price with strong selling volume. Another important pattern is the doji. In a doji, the opening and closing prices are very close together, and it often has tails on one or both sides. A doji basically says, the market is undecided. Neither buyers nor sellers were able to win clearly during that time period. If a doji appears after a strong trend, it can be a warning that the trend is losing energy and a reversal or a pause might be coming. If you also see long tails on that doji, it means price moved up and down but ended up going nowhere. That's confusion, and confusion often comes before a change. Section 7. Putting it all together. Context is everything. A candlestick pattern means very little if you don't look at the bigger picture. You always want to ask, what is the overall trend? Where is this candle forming? At the top, at the bottom, or in the middle of a range? Is there a support or resistance level nearby? What is the volume doing? A hammer in the middle of nowhere on the chart is not as powerful as a hammer at a strong support level after a long downtrend. A shooting star at a major resistance level after a big rally is much more meaningful than a random shooting star in the middle of a quiet sideways move. So don't just memorize names. Learn to read the story. Who is in control, buyers or sellers? And is that control changing? Let's turn this into something you can practice, even if you're a total beginner. Step 1, pick a stock chart you like. Step 2, switch the chart type to candlesticks. Step 3, look for trends. Can you see periods where price is clearly moving up or down? Step 4, at the end of these trends, start searching for hammers, small body on top, long lower tail, shooting stars, small body on bottom, long upper tail, doji candles, small body, looks like a plus sign or a cross, sometimes with long tails. Step 5, after you spot one, look at what happened in the next few candles. Did the price actually reverse? Did volume increase? Or did the candle fail and the trend continued? Doing this on historical charts is like doing homework for the market. It trains your eyes to recognize potential reversal signs in real time. If you made it this far, you're already ahead of many beginners. Most people skip learning how to read price action, but you're actually learning how to read the story behind the candles. If you found this video helpful, please hit the like button. Subscribe if you want more simple explanations about stock market and investing. Turn on the notification bell so you don't miss future uploads. And in the comments, tell me, which pattern are you going to look for on your charts this week? Hammer, shooting star, or doji? Share this with a friend who's also learning to trade. Thanks for watching, take care, and I'll see you in the next video. Until then, keep learning, stay patient, and remember, your goal is not to predict every move perfectly, but to make better decisions over time.